Hi guys, welcome to my channel. Today we are going to talk about Wells Fargo and what did they do which spooked the market. Second thing, we are going to talk about commercial lending and what the big banks think about it. The third thing, we are going to talk about loans and why the big banks are rejecting more of it. The fourth thing, we are going to talk about JP Morgan and what is their action plan during such kind of scenario and why are they holding huge amounts of cash in their balance sheet. If you have come here for the truth, let me unveil that for you. Wells Fargo tells customers it's shuttering all personal lines of credit. The bank is shutting down all existing personal lines of credit in coming weeks and no longer offers the product, according to letters reviewed by CNBC. The revolving credit lines, which typically lets user borrow $3,000 to $100,000, were pitched as a way to consolidate high-interest credit card debt, pay for home renovations, or avoid overdraft fees on linked checking accounts. Wells Fargo warned customers that the account closure may have an impact on your credit score, according to a frequently asked questions segment of the letter. Wells Fargo is ending a popular consumer lending product, angering some of its customers, CNBC has learned. The bank is shutting down all existing personal lines of credit in coming weeks and has stopped offering the product, according to customer letters reviewed by CNBC. Wells Fargo recently reviewed its product offerings and decided to discontinue offering new personal and portfolio line of credit accounts and close all existing accounts, the bank said in a 6-page letter. The move would let the bank focus on credit card and personal loans, it said. In 2018, the Fed barred Wells Fargo from growing its balance sheet until it fixes compliance shortcomings revealed by bank's fake account scandal. The asset cap has ultimately cost the bank billions of dollars in lost earnings based on the balance sheet growth of rival including JP Morgan Chase and Bank of America over the past 3 years. It has also affected Wells Fargo's customers. Last year, the lender told staff it was halting all new home equity lines of credit, CNBC reported. Months later, the bank also withdrew from a segment of the auto lending industry. Now, one thing we need to understand is that this Wells Fargo bank is halting personal lines of credit, and previously they also halted home equity and auto lending business equity. And they are saying that they want to focus on credit card loans and home loans. With its latest move, Wells Fargo warned customers that the account closure may have an impact on your credit scores. Another part of the FAQ asserted that the account closure couldn't be reviewed or reversed. We apologize for the inconvenience this line of credit closure will cause, the bank said. The account closure is final. Now, first thing, they are apologizing for this inconvenience, and then they are saying this account closure is final. So, what does that apologizing mean? Why are they apologizing? Now, Senator Elizabeth Warren commented on Wells Fargo, saying that not a single Wells Fargo customer should see their credit score suffer just because their bank is restructuring after years of scam and incompetence. Sending out a warning notice simply isn't good enough. Wells Fargo needs to make this right. Wells Fargo didn't directly answer questions as to what role, if any, the Fed asset cap played in its latest move. After publication of this article, a Wells Fargo spokesman gave additional remarks. We realize change can be inconvenient, especially when customers' credit may be impacted, the bank said, adding to that it was committed to helping each customer find a credit solution that fits their needs. When the personal line of credit was offered, the credit lines had variable interest rate ranging from 9.5 to 21%. That interest rate is very huge for a person who takes $50,000 or a $60,000 loan. The move is a strange one given the banking industry needs to boost loan growth. Now, the second thing today we are going to talk about is commercial lending. Wells Fargo bullish on commercial lending. JP Morgan not so much. Wells Fargo has seen demand for business loans shrink substantially during the pandemic but expected to pick up in the second half of the year as the US economy rebounds. Borrower demand remained muted during the first quarter, but exceptionally strong credit performances and a smaller loss allowance bolstered the company's results. Shares in Wells Fargo rose by more than 5% after executives said that they anticipate growth in commercial loans later this year, which would buoy the firm's sagging interest income. The demand across most commercial client segments have been pretty weak. Chief Financial Officer Mike Santomassimo said Wednesday during the company's quarterly earnings call. But we do really expect to see demand starting to pick up as the economy picks up. Based on the previous article that we have seen that Wells Fargo is restricting all personal loans, this scenario is completely opposite. It is bullish on commercial lending, and commercial debt is at an all-time high, and I have specified it in my previous video. I'll put down a link at the end. Now coming to this article from Bloomberg, we get to know that big US banks cut loans to record low again as deposits jump. The 25 biggest US banks collectively reduced their loan holdings by 8% in the year through March, according to the Federal Reserve's last week's survey. Total loans fell by $447 billion to 5.45 trillion, Fed data show. Meanwhile, total deposits, which provide the funds that bank lends out to borrowers, jumped 16% to $10.13 trillion. Their combined loan-to-deposit ratio now sits at 53.9%, the lowest reading in 36 years of weekly Fed data. Had the largest US banks maintained their lending level of this time last year, they'd have an additional 1.37 trillion of loans on their books today. Some highlights of all US bank holdings: the share of safe asset, virtually risk-free investments such as cash, treasuries, and security effectively guaranteed by US government slipped to 35.6% in the week that ended March 31 from 36% the previous week. Total assets ticked down slightly to $20.91 trillion from $21.04 trillion. Loans across the US banking industry comprise less than half of their total assets, continuing a post-pandemic trend. Now, this article clearly showcases that the entire banking industry is cutting down on loans, and they are also reducing the amount of cash and treasuries and the US securities. Now, where are they investing in? We have no idea because it is all insider information. Look at this chart, viewers. Now we see that the safe assets versus loans and lease. The safe assets is the white line, and the loans and the leases is the blue line. The safe assets have increased drastically since 2020 in a parabolic way. Understand that these loans and leases have reduced significantly since the post-pandemic era. Now the second is the US banks balance sheet items as a share of total assets. Now there is a comparison between the large banks and smaller and foreign banks, which are in white color. The large banks consist of 15% of their assets in cash, but smaller and foreign banks have larger portion of them in cash. Large banks consist of agency mortgage-backed securities, but less amount of home loans, CRE loans, consumer loans, and C&I loans. This is the similar trend, but we see smaller and foreign banks having large percentage of CRE loans in their asset column. Once you analyze this chart, we need to question one thing. Why do these retail investors require less amount of loans? The US government is giving free amount of money in the form of stimulus checks. Now, before we get into the next article, I want you to remember all of this that I have specified in terms of why banks are not spending enough money and why aren't they giving enough loans. JP Morgan's Jamie Dimon makes a $500 billion bet inflation is here to stay. JP Morgan is stockpiling cash in a move that shows definitive confidence that inflation is here to stay. Although the Federal Reserve has been staunch in their stance that inflation is transitory and a side effect of persisting pandemic pressures, JP Morgan CEO Jamie Dimon believes otherwise. If you look at our balance sheet, we have 500 billion in cash. We have actually been effectively stockpiling more and more cash, waiting for opportunities to invest at a higher rate. I do expect to see higher rates and more inflation, and we have prepared for that. The reason this is of particular importance is because during even transitory times of inflation, banks especially will try to rid their balance sheet of as much cash as possible. Banks are astute to this and are typically some of the quickest to purchase inflation hedging assets like real estate and commodities, which perform better as price rises. What is unique to this particular possibility of inflation is that the largest American bank is holding its cash position before deciding to purchase any assets, in almost a defiance of Fed's repeated recommendation that inflation will eventually go away. The volume, though $500 billion, means that the bank is willing to risk an incredible loss of money on the bet that interest rates are set to rise significantly for the first time in almost a decade. We need to understand that the biggest bank in the United States is betting for inflation. This is the primary reason why all banks have reduced their purchasing power and are hoarding cash or buying other assets. Giving away loans for the general population creates a risk of default for the banks, and they can't risk it in such a situation.